Welcome to this explainer. Today, we're taking a magnifying glass to an absolute titan of industry, Caterpillar. We're going to shatter a massive misconception right out of the gate. Because if you think Caterpillar is just some legacy manufacturer of, boring yellow dirt movers, well, you are missing the real economic engine that's actually driving this company. So honestly, I have to ask, when you hear the name Caterpillar, do you just picture a tractor company? Do you think of them strictly as a cyclical manufacturer, completely tied to the unavoidable ups and downs of global construction? Honestly, if you do, you're not alone. That's kind of the dominant perception out there. But as our sources show, it's just strategically incomplete. There's a massive knowledge gap between that perception and the reality. Okay, let's just wrap our heads around this number for a second. 3 million plus. Since they were founded way back in 1925, Caterpillar has built a truly colossal scale. Right now, today, they have over 3 million massive machines operating out there in the absolute harshest conditions on Earth. We're talking lithium mines in the Atacama Desert to construction sites out in the freezing Canadian permafrost. This isn't just equipment. It is a 100-year-old global footprint that absolutely no competitor can just replicate overnight. And breaking down their revenue completely shatters that just construction myth. Yes, construction industries makes up about 38% of their revenue, but energy and transportation, that's a massive 35%, right on its heels. Then you've got resource industries, which is heavy mining, bringing in 22%, and financial products at 5%. They are so much more diversified than the market gives them credit for.
Which brings us to part one, the aftermarket revenue flywheel.
You guys have probably heard of the razor and blades model, right? You buy the razor handle on the cheap, and boom, you're locked into buying those expensive replacement blades for years. Well, Caterpillar operates incredibly similarly. Selling a multi-million-dollar excavator isn't the end of the transaction for them. Actually, it's just the beginning of a highly lucrative, decades-long relationship. So here's how that flywheel actually spins in the real world. Step 1. You've got the initial machine sale. Step 2. They use Cat Connect, which is their advanced telemetry and software system to proactively monitor the machine and predict exactly when it's going to need servicing. And step 3. That proactive monitoring drives 15 to 25 years of aftermarket parts and maintenance. And here is the absolute kicker. While selling the original equipment gives them a margin of around 18 to 22%, this aftermarket ecosystem, it boasts margins well over 30%. So the crucial takeaway here is understanding this contrast. Sure, you have the cyclical reality of selling the original construction equipment, which naturally ebbs and flows with the global economy. But that cycle is heavily insulated by the secular, unstoppable growth of their aftermarket parts and services. Remember those 3 million machines? They constantly need parts, regardless of whether the broader economy is booming or totally busting. It's effectively like collecting permanent rent on global infrastructure. Moving on to part 2, the hidden AI tech play. Okay, it might sound kind of crazy. I mean, nobody looks at a giant bulldozer and thinks Silicon Valley. But Caterpillar is quietly powering the artificial intelligence megatrend. Remember that energy and transportation sector we just mentioned? The one making up 35% of their revenue? Well, it is experiencing explosive structural growth right now, turning Caterpillar into this hidden tech play that a lot of casual analysts completely miss. Think about it. Every single time massive hyperscalers like Microsoft, Google, or Meta build a new AI data center, they need guaranteed fail-safe power, period. Caterpillar's massive natural gas and diesel generator sets are the default backup power for this critical infrastructure. They are quite literally keeping the lights on for the AI revolution, just perfectly positioned to ride this massive $200 to $300 billion annual data center capex boom projected out to 2027.
Now, let's hit part 3, financial fortress and dividends.
When you track the financials, you can clearly see this massive pandemic-era margin peak. We're talking operating margins jumping from 13.5% back in 2021 to around 20% by 2023 and 2024. But the absolute most vital metric to pay attention to is their free cash flow. They generated nearly $9.8 billion in free cash flow in 2024 alone. That is structural, hardcore cash generation that survives pretty much any economic cycle. And what exactly do they do with all that cash? Well, for starters, they share it. Caterpillar is a certified dividend aristocrat. They've got over 30 consecutive years of dividend growth under their belt. And what's really remarkable is that they pull this off while maintaining an extremely conservative payout ratio, just 25 to 30% of their earnings. So that dividend, it is incredibly well protected. And the rest of that massive free cash flow?
It goes straight to aggressive, consistent stock buybacks. They spent roughly $5.5 billion on buybacks in 2024 alone. To put that into perspective, they've effectively reduced their total share count by an astonishing 18% since 2016. No way, right? But it's true. Each remaining share represents a progressively larger slice of a growing pie. They allocate capital beautifully, avoiding those massive, destructive acquisitions in favor of just returning value directly to the core business.
All right, part 4, the tariff threat.
We need to objectively break down the Section 122 tariffs invoked in February 2026, which mandate a 15% universal tariff on imports. For Caterpillar, the hit comes from multiple directions. First, their production costs rise for components they import from places like Japan and Europe. Second, their U.S. clients who export materials start to feel the financial squeeze, which could potentially cause them to delay their own equipment purchases. And finally, there's the risk of trade retaliation. This could accelerate Caterpillar's loss of market share in China, a region that historically made up 5 to 8% of their revenue. It's a really complex web of macroeconomic cause and effects that has to be watched closely.
And that tariff pressure leads us right into the whole margin debate. We talked about that exceptional 20% peak margin earlier, which, to be fair, was heavily driven by pandemic pricing power and massive backlogs. Well, the expectation right now is a normalization down to a more sustainable 17 to 18%. This is due to a combination of those rising tariff costs, increased global supply, and independent dealers finally destocking all the excess inventory they hoarded over the last couple of years.
Which brings us to our final section, the final verdict. The reality we see from the sources is that Caterpillar is a true compounder, quietly building the next century. Yes, they definitely face cyclical construction dips, and yes, the current tariff environment presents very real, tangible hurdles. But when you zoom out, Caterpillar remains an absolutely critical enabler of our modern world. At their core, they are fundamentally powering the energy transition, critical mineral mining, and that massive AI data center infrastructure build-out we talked about.
So I'll leave you with this final thought to consider. Do the very real short-term tariff and margin headwinds outweigh the decades-long compounding power of a company that is, quite literally, building our future infrastructure? It's a fascinating dynamic. I really hope this explainer gave you a much deeper understanding of the true engine running Caterpillar. Thank you so much for joining us, and keep questioning the narrative.